Welcome to DF Markets Money Management Part 2. In Section 1 we looked at the importance of proper position sizing, understanding lot sizes and the importance of risk reward. In this section we are going to focus on the importance of a proper trade management, which is an essential part of your overall money management. When it comes to trade management, there are 4 key areas to focus on: stops, targets, trailing stops, and scaling in and scaling out of trades. As we mentioned in the first section, it's incredibly important to ensure that your position sizing is correct, to make sure that you don't overly expose yourself and risk sabotaging your performance. However, to correctly gauge your position size, along with understanding lot sizes, you need to have a stop loss. Stop losses. A stop loss is just a level in the market at which a losing trade will automatically be closed. To work out your position sizing, you need to establish a stop loss and then adjust your lot size accordingly. So, for example, to risk 1% of a $1,000 account on a trade with a stop loss of 50 pips, you would need to be trading at 2, which is 20 cents times 50 pips equaling a $10 risk. It is important to make sure that you always risk a uniformed amount per trade. So you need to make sure that you always use a stop loss in order to be able to work out your lot size to keep your position sizing correct as well. Trailing stops. Once your position is in play, it is important to monitor its development with respect to adjusting your stop. For example, once your position is in profit, it is prudent to make sure your stop loss moves to break even to protect you from letting a winning trade turn into a loser. Moving your trade to break even essentially means moving your trade stop to your entry point. In this example, you can see that we are short from 0.7894 with a 100 pip stop at 0.7994. Once price moves 100 pips in profit, we can then bring our stop down to our entry level. This means that if price reverses and trades back up again, instead of losing, we simply come out at break even. Similarly, if price continues to trade in our favour and our profits grow, we continue to trail our stop down to lock in profits. So in this example, if price moves down another 100 pips, we could bring our stop down by a further 100 pips. If price reverses and hits our stops, we come out with a 100 pip profit. Targets. The final part of the money management puzzle is setting targets. We talked about the importance of good risk reward and how that amplifies your returns. To this end, it's important to always target a multiple of risk and not take any trades that does not seem like there is likely to make a good return. A good rule of thumb is that if the target on your trade is less than 2 to 1, steer clear. Setting a good target, however, does not mean that it is arbitrarily a target of 2 or 3 times your risks. It means that you assess the market, look at your stop, and look at the target location. And if the risk reward is good, you take the trade. If it isn't, you don't. It is also vitally important to stick to your targets and not fall into the trap of exiting earlier because you think the market is turning. Operating in this manner will reduce your risk reward over time.